I want to go and talk about Asia, which I mentioned at the beginning is a very, very polarized story with what we see against China. You think about how the equity markets in Asia have performed as well, Xing out China and Xing out Japan. In the last 2 years, they've been very, very flat, okay? And previous to that, for 3 years, since about 2010 to 2013, they were absolutely skyrocketing when China was being very flat. So when we talk about, and when you do choose to invest in Asia funds, do think about where their asset allocation lies. With GDP growth going forward this year, the predictions is that if you encounter the whole of Asia, including China, it will be 53% of the world's growth, contribution to growth. Again, we're not macro pickers, but we're just saying from the perspective of potential, where do you actually want to be? What's interesting about the whole region's relative valuation set is that this time last year when we presented to you on Asia, China A shares were here to the far right, and China H was about here, and Korea is exactly where it was. We are not emotional, as Alan has mentioned, about the way that we pick stocks. If China A is trading at this point, then we start diluting those holdings and moving more into H, where the value is. Again, no emotion. And again, reiterating the point about when you see market corrections and the commentary that's being given, be very, very clear when your client calls you up and shows you the Melbourne Age finance section, that you explain to them that the Premium China Fund is not heavily invested in that market that has had a severe correction. We show this chart up every year, and I'm going to keep showing it because 10 years ago when we started our business and there was only a handful of advisors that knew how to spell China, today everyone not only knows how to spell China, but they know about what China is. Now we're at the education point about Greater China, being Hong Kong, Taiwan, and the mainland of China. Let's start with Korea. Now you're going to start to see this pattern. ASEAN has been impacted by a couple of things that are quite external to them. Anticipation of US Fed rate hike. That's more about anticipation more than reality, and that does cause volatility in the market, as we do know. Number two, oil prices have obviously fallen off dramatically, and some of these nations, such as Malaysia or such as Indonesia, are very much tied to oil prices. Now there's a positive, there's some light at the end of the tunnel, which I'll talk about in terms of Thailand, but the oil prices obviously impacted them. Then you've also got currency depreciation against US dollar, which in some cases is good for some economies that are externally focused, but some which are not. Korea has been impacted by MERS. Did anyone remember MERS, the Middle Eastern Respiratory Syndrome? Well, that impacted them so bad that the government had to announce a 26 billion Australian dollar stimulus package to cover. And so a lot of tax breaks came in through there. But you can see GDP growth is no different to Australia. Inflation is probably a bit lower than Australia. And one of the things that we do like, though, is what's happened to the dividend yield. Do you remember last year when we talked about Korea, which today is still 15% of the Asia Fund's portfolio? We talked about buying preference shares because they were trading at a deep discount to the ordinary shares, but you picked up, obviously, a high yield, dividend yield. At the same time, the government was looking into how to force companies to pay out more dividend. Because 12 months ago, Korean equities had a dividend yield of 1%. Today, they have an awesome dividend yield of 1.5%. Now, that is an absolute joke from an Australian perspective, but how much has it risen by? 50%. And it's because of the excess tax levies, excess cash levies that have been put on Korean companies since December of last year, whereby you work out your net profit, less capex, and less increases in wages to your employees, and any of that excess cash that you aren't paying out in a distribution, they will tax you at certain marginal rates. But you don't have to pay that tax till 2 years from now. So it's forced a lot of Korean companies to reevaluate themselves as to what they want to do with their cash. You can see here at the bottom, we're looking at the difference, because Korea obviously exports a lot of goods. And the real exports for them is the part that's actually weak, whereas domestic demand is what they're relying on to keep themselves head above water. And that stimulus package will help. But overall, the growth picture is not so great. So we're focusing on buying structural reform. So you can see here with the first part here with the Korean preference shares, 2 to 3 years ago, the discount was about 30 to 40%. But now it's back up to only 20% discount. And about a third of the 15% we hold in Korea is exactly this. 2 stock stories I want to share with you about Korea. First one, GS Retail. So this is Woolworths. Have a think about Woolworths or Coles. What is the highest margin type of products they sell outside of alcohol? White label, so no frills, home brand, because they removed the wholesaler. Now, prior to 2 to 3 years ago, Korean companies had no incentive to be able to create private brands because everything they sold was mandated by the government in terms of pricing, whether it be toothpaste or cup noodles. But now they have the ability of doing things called private brands. Now, for those of you that have been to the United States, have you been to a Whole Foods? And in the Whole Foods, you have these places where it's like a canteen and you pick up food and then you weigh it. What's the margin on that? It's incredibly high because they're cooking the food themselves. So they're doing the same now and implementing this at GS Retail. And for those of you that have been to Asia, Asians love lunch boxes. And I mean lunch boxes like those takeaway ones where you put a whole bunch of rice and then obviously a meal is attached to it. So that is the higher margin stuff that they're going to be producing going forward. They've also received some tax breaks as well, which has also improved their situation. But it's not that awesome because its revenue growth is 5% up from 3%. And in context of a 1.5% consumption growth rate in Korea, it's pretty good. Now, they're trading at 23 times today's earnings. And against the Japanese retailers, which are trading at 30 times, it's comparably cheap. So this is why we've got GS Retail. So I just showed you a stock that we did very, very well at. This is a stock that we haven't done so well at, Samsung. And a lot of people say, oh, Jonathan, you buy Samsung so you can talk about it at a roadshow. Well, no. Platinum has also bought into Samsung, and they're talking about this. Now, some of you may have been to the Morningstar conference a couple of months ago, and Andrew Clifford from Platinum and Eric Sappenfield, who's the Chief Investment Officer of Epoch Investment Partners, otherwise known as Grant Samuel Global Shareholder Yield Fund in Australia, were going head-to-head against each other talking about stock ideas. And Eric Sappenfield said, we focus on buying good blue-chip global names that pump out ever-increasing dividends every year. And then Andrew Clifford said, well, that's interesting because Nestle trades at about 25 times earnings. It keeps paying out dividends every year by increasing it, but they're paying it out of more than their actual operating cash flow. Then at the same time, they haven't actually had any growth in the last 5 years, and they've only generated marginal growth by doing share buybacks. Why do I want to buy that if Samsung is trading at 8 times earnings, where 30% of their market cap is in cash, their price to book is 1.1 times? Here's why Samsung hasn't done so well of late, is because of their product mix. So you have to remember that Samsung has got 4 divisions: componentry, handsets, OELDs, and virtual RAM. Now, 60% of Samsung's revenue comes from selling handsets, which they don't like because it's like an ever-evolving circle of Apple, Samsung, Apple, Samsung, right? Samsung comes out with handsets in October, November, and then every fall, Apple comes out with their new phone. So they just keep fighting every year. And what occurred to them was they came up with a great innovation last year called a curved screen. So that was called the S6 Edge. What they expected out of the S6 and the S6 Edge was they expected to sell 70% of handsets was S6 and 30% was Edge. But in actual fact, the global community embraced the technology and ended up to be 50-50. Because of the fact that Samsung produces its own curved OLED screens, they could not produce or pump out them fast enough, which led to them not being able to sell as many phones as they liked. We like Samsung going forward because of 2 reasons. One, the valuation is very cheap. That takes the emotion away from it. Number 2, their innovation that's coming through the pipeline is incredible. Because I spent some time with our Korean analyst last week, and she said that Samsung is very, very close to building a foldable screen. Now, for those of you who noticed in the news on Monday, they actually patented the foldable screen technology. So the innovation product pipeline is very good. The other thing is that 60%, as I said, of total profit comes from handsets. They want to split that across the 4 different divisions. There's nothing to make in TVs anymore because it's 55-inch screen, costs $1,200. But what makes the most money is SSD drives. Does everyone know what SSD, otherwise known as solid state? So remember back in the 90s, you bought a hard drive and it kept spinning and it's got a massive fan on it. Nowadays, they're all really, really tiny and there's no fan because there's no moving parts. Samsung controls 1 in 4 of every SSDs that's sold in the world, and they have the fastest and most secure and most reliable SSD drives in the world. So that's what one looks like. Stuff that you force on your iPhones today is effectively these, and they're just getting bigger, and also the technology is also getting cheaper, which is also very important for a group like Samsung. So valuation-wise, it looks like they haven't done so well in the last 12 months, but going forward, this is the contrarian story that we're buying into. If we move to Thailand, again, reverse downward trend for GDP growth. They're cutting rates like crazy, which is exactly where we're seeing with most of the other Korean economies as well. And all we're holding is defensive, strong 4 to 5% yield plays. 2 companies. One's called Bangchak Petroleum. Now, let's talk about the oil story. Again, contrarian. Does everyone understand that because of the oil price decrease, there's been $200 billion of capex going into oil fields that have been put on hold? Now, what happens when you put these projects on hold? The supply actually tapers off, but your demand still is constant. So we believe the price of oil will increase. The other thing to note is that every country in the world has a very, very different production price for oil. So the most expensive country to produce or dig up oil into a barrel is Iran at about $73 per barrel, and the cheapest is the United Arab Emirates, which is less than $20 per barrel. So with Thailand, we bought a petroleum company looking at the long-term trend that oil prices will recover. And number 2, the other holding we're having is called True Telecom, which is just a poles and wires company that's built into an infrastructure trust that we bought into it because it also generates 5% yield. Because these companies are continually just putting poles and wires because the ever-increasing demand of data in emerging Asia. Singapore is the other place that we're holding about 5% of our portfolio. Here's the thing. We hold 7 companies that make up the 5%. 6 of those companies aren't even Singaporean. You have to remember that Singapore is quite an interesting market. As a country, there's nothing exciting, and they're going through a period of pretty tough times because their currency is actually held up very strongly against the rest of the world. Whereas places like Malaysia and Indonesia, the rupiah and the ringgit, respectively, has collapsed. But if you look through the history of the markets in the last 20 years, Singapore's correlation with Australia and the United States and Europe is far higher than they have with the correlation with the rest of Asia because it's seen as a developed market. So there are companies that hide from other places like Taiwan or China that choose to list on the Singaporean Stock Exchange to remove some of the volatility on the share price. So 2 interesting companies that we hold, one's called Asian Pay Television. And what are they? They're the Taiwan's largest pay television subscriber, but from Taiwan, not Singaporean. And the other one is Zhejiang Shipping, which is one of the world's best shipbuilders that is also trading at 8 times PE with a 4.5% dividend yield. But it's a Chinese company and not a Singaporean company. So why we're investing in a place like Singapore is solely because it is a defensive market. If we look at the rest of Asia, there's some structural issues that we're finding very difficult for us to value a lot of companies. The best example is Malaysia. They've implemented GST. Do you know how difficult it is as an investment manager to actually go and think about what GST looks like and impacts across the economy until you actually see it? That's why, if you look at these 4 countries put together, we only hold, Malaysia, Philippines, Indonesia, we hold less than 5% of the total portfolios there. We hold 4% in TSMC and Taiwan, but that's been a long-term holding of ours anyhow, which we talked about last year. Philippines is the most expensive place at the moment with 18 times earnings, so there's nothing deep value that we can buy. And Indonesia is faced with big issues relating to their oil, where we, again, cannot find decent investment opportunities. The risk that we see is US rate hikes, as I said, in terms of the anticipation of the rate rise as opposed to the rate rise themselves. It's quite interesting because everything that's happened the last month is piled on at the same time. So you've had the Brexit issues and China volatility happen at the same time, but they're definitely not correlated for obvious reasons. The biggest risk to us ultimately is stalling policy development. By no means do we believe that Chinese politicians are better than Australian politicians or better than US politicians. Politicians are politicians. And the only difference for a place like China is that they are given more time to prove their worth. They're given more time to put forward plans for a 10-year period to prove that they can actually achieve some good development for the country. So for China, we believe that for the next 5 years, up until the 8th year of the leadership, we're going to see some pretty good stuff. In the last 2 years, nothing really happens. It's like a caretaker mode. And the last thing, it's quite interesting with, as Alan mentioned, ANZ doing a cap raising now, Westpac doing more cap raising as well, is what have we seen the banks do of late? They've gone and increased their rates. And what's their justification? Because they think we're all become high risk for them. So that's where they're squeezing out their earnings. You have to consider where Australian companies can continue to squeeze out earnings going forward. There is an argument that some Aussie equity managers are coming out with and saying we're not going to buy BHP and Rio anymore because they're not linked to China. But there are other companies we can buy in. Seek, because they have an operation in China, Commonwealth Bank, because they have an operation in China, Navitas, because they have an operation in China. So people are using this argument now to get you to invest more and more heavily into Australian equities, which I find quite interesting. So with the fund update, inside your packs, you'll find one of these sheets with all the fee schedules inside of it for all the funds and the characteristics. Some additions in terms of platforms. We are now on Hub24, both investment and super. For those of you who use BT Wrap, we're also being added on the capital protection menu for BT Wrap, which I believe is very similar to AXA North. Other than that, we're on most platforms in the country, except CFS First Choice and ING One Answer. With the Prim Asia Fund, it's challenged and held on to about 15% net of fee return for the 5 years that we've had. You can see the geographical exposure here. I just want to explain this negative 21% cash because a lot of people have been questioning what that is. That was the 18% distribution because this was as at the 30th of June. So we had to prepare for that distribution to come through. So you have to discount all of these holdings by 0.8 to work out what the real holding is in that particular market. One interesting thing that is different in the Asia Fund, because it's run by our Deputy CIO, Renee Hung, and it's different to Alan running the China Fund, is our top 2 holdings. Has anyone been to China and tried Chinese white wine? Now, I'm not talking about Chardonnay, I'm talking about absinthe, right? The equivalent of 70% alcohol, pure, almost pure alcohol. Now, this stuff sells like crazy in China, but what's occurred is that with the anti-corruption run, politicians used to get paid in Maotai and Wuliangye as a form of payment in kind. And, well, it's corruption. And you have to remember that after the anti-corruption, people thought the demand of these 2 types of wines would decrease significantly. What people don't understand is that there's going to be more people in the country than there are politicians. At least you'd hope so. And number 2, the margin for these 2 types of alcohol, 85 to 90%. I have a friend in Sydney who his wife owns the exclusive distribution rights of Maotai in one province of China, one of 32 provinces in China with a population of about 50 million people, where you can retire on that at these types of margins. This is us, since inception, against all our competitors that started before us, or at the same time as us, because you can't put data on that is not funds that have started after us. With the Prim Asia Property Fund, and an investor in Perth asked us, I have got a bunch of money that I'm setting aside for my grandchildren. I don't care about volatility. Which fund should I invest in? It's this fund. because it's one of the smallest funds that we have. And as you can see here, we've annualized at 18%, and that was launched over 8 years ago, per annum net of fees. What scares most people with this fund is the fact that it's all real estate. But it's a very, very logical conclusion as to why we're holding real estate, as per what Alan discussed earlier. But number two, this fund is very simple. We target the way the Asian countries are dealing with their property market. When the property market is hot, we pull out of developers and throw them into REITs, which on general between China and Singapore pay 5.5% to 6.5% yield. When the property market gets absolutely hammered by Chinese government intervention, we then buy them up again because their valuations become exceptionally cheap. So at the moment, we're at a point, like kind of a midpoint, because the valuations aren't super cheap relative to where they were 12 months ago, but they're also not super expensive. But we're still holding some REITs as a defensible position. So you did see a distribution for your clients on this fund for the year that was just passed of about 5%. And this is what we look like since inception against all the other PropSec funds that you invest on behalf of your clients. Now, please note, ladies and gentlemen, this volatility, what's interesting about this volatility is that it is still only 18.7% and just as volatile as the China fund. But we have overachieved at 18% per annum net of fees. The last fund that I want to mention, and we launched this 3 years ago, is our fixed income strategy. And this fund sits at 15 million Australian dollars today. Everyone thinks that this is the highest risk investment that you could generate because you have Asia income inside the name of the fund. If I screened out the words Asia and replaced it with Australia and gave you the same characteristics, would you buy it? Because there's one thing that I certainly don't believe in, is that because the country is more volatile, it means that you shouldn't invest in it. That doesn't make any sense to me, because if your particular investment manager you have chosen specializes in the region, they would generate the returns. So this fund's been around for 4 years, and we've generated an annualized return at 11.6% with a volatility of 5.6%. And ladies and gentlemen, we buy sub-investment grade, high-yielding bonds, or bonds that aren't even rated at all. Does that scare you? We buy non-rated bonds. People have not glanced their eye over it. But isn't that where you find the value? This is the only fund where we promise you that if a 5 sigma event occurs again, like a GFC, we will freeze your client's money in this fund. We will. Why? Because I don't think your clients would complain if a 5 sigma event occurs that we're going to freeze the fund and pay your clients out 10.7% for the next 5.6 years. Because as opposed to an equity fund, bonds have a natural put option. And the natural put option will come through as long as there's no defaults. But if we've done our research correctly, and note that between 2011 till today, there has been 2 significant emerging market fixed income routes where it's caused significant defaults across the region. We have not copped one of them. And I'll tell you a reason why. Because we do our research properly, and number 2, we keep the portfolio concentrated. So this is the most concentrated portfolio we have out of the 4 funds. It holds 44 bonds, not 500 bonds. Right? What happened to those managers prior to the GFC that held 500 bonds? They all went down. Hybrid income, all went down. And to scare you even further, 42% of the portfolio is held in real estate bonds. This is when you should really run. Now, let me ask you, why are we doing this? Because it's the most homogeneous investment you could ever buy. If Samsung came out today and said, we are going to raise $2 billion in bonds because of these 17 reasons, how do you link the $2 billion to those 17 reasons and then work out at the end of it what the ROI is? Think about it. For those of you that heard me speak over these last decade, I only talk in very common sense terms. You cannot intrinsically link the bond issuance with the return on that investment within the company. Not your coupon, but what the inherent return for the company is to justify issuing out those bonds. With property developers, what do? They say, we need to raise $2 billion to fund these 10 projects. And what does every property developer do? They acquire the land, They pre-sell some of the property, they build the property, they sell the rest of them, and they give you back your money. We can intrinsically link that property development with that amount of bonds that's being issued into the market. This is why we love real estate bonds. It's just so simple for us to measure. And this is what our fund performance looks like against the managers you use. Right? And we're generating it at 5.6% volatility. It is far lower risk than you may think yourself. So if you're considering what your fixed income portfolio looks like today, and advisors have been in the last 6 or 7 years just trying to squeeze the last bit of yield out for your clients, less your advice fee and less your fee for platforms, what is left for your client? You need to find something that is far higher reaching. The last thing I want to mention to you, or second last thing, this is what your dealer group tells you to do. And I want you to think about this. What does your portfolio look like, personally, in your super fund, compared to your clients? Is it similar or is it different? In most cases that I've seen, it is very different because we have a ginormous amount of advisors that have money in our funds but don't put it with their clients. So how is that different when you visit your doctor and he said, you have a cold, I'll give you an antibiotic, and then you ask the doctor, would you take this antibiotic yourself if you had this illness? And they said, no. Does that give you any confidence? We need to do what we do for ourselves, for our clients. If you had a fresh start, would you start with a blank piece of paper and write down what your 5 best investment ideas is? Because what do we do now? We go, all right, so my dealer tells me I need to do 22% in Australian equities. I'm going to go find the best Australian equity funds I can find to fit into that model. And I'm telling you this as a practitioner, because I've been a practitioner for a decade as well. Why don't you try this and think about this? And the other thing is, introduce funds to your clients that they have never heard of or in asset classes they have never considered. Because what else are they paying you for from a return perspective? The final thing is we're doing this campaign on client education seminars. So at the moment we're doing about 2 per month. And these client education seminars are quite simple. I've spoken to a number of you that I've visited your office in the last 12 months. And we are offering a $500 subsidy towards catering or food or whatever it may be, but we are not paying you money and we're not certainly paying your clients money. And so I'd like you to note down on your feedback forms, there is a question there that asks, would you like to run a client seminar? If you're interested, whether or not it is in a larger group setting or it's personally for you where we subsidize $500, note yes and we'll come in contact with you and discuss it. Because it is a win-win-win because it's a win for you because you increase your client engagement. It's a win for your client because they get more education. And number 3, it's a win for us because we will get fund flow. Because here's what I'm trying to do, and I started with this theme last year. I'm trying to create frictionless commerce for you to be able to use our funds in the sense that I want to remove the process by which you are educating your clients because that seems to be a big sticking point. Our presentations are very long. Our decks are very long because the things that we discuss can be highly technical from an Australian perspective. So let us do the work for you. And we know that if you engage us to do any form of client seminar, we know that you understand the story and you are comfortable with the returns and the profile of returns that we generate for your clients going forward. So let us do the work for you. So as I said, on the feedback form, there's a tick box there.